Loan officers talk about the mortgage rate roller coaster as something of a metaphor. Here we're going to get a chance to actually ride the mortgage rate roller coaster from 2010 using data from Freddie Mac. We're going to see how the 30-year fixed mortgage rate plots from January 1st to December 31st. And when the year started, mortgage rates were at 5.19%. At the time, the Federal Reserve was in the middle of a very large support program for the mortgage bond market that was meant to provide liquidity and help keep mortgage rates low. And by all parts, the Fed's program actually worked. It was creating extra buy-side demand, and because mortgage bonds are based on the price of mortgage-backed securities, extra demand helped to drive down rates. But as the program was coming to an end, the end date was March 31st, we started to see pressure on mortgage rates to rise, and that's because the Fed was going to be withdrawing from the market. Now, at the same time, right around the middle of March, there started to be some concerns about what was happening in Greece, that Greece was going to default on its debt. They call it sovereign debt. And so even though the Fed was withdrawing from the market, concerns of what was happening in Greece and some of those concerns spreading over the Eurozone began to push mortgage rates higher. We saw that as March was coming to a close, even though we expected rates to skyrocket, they didn't, and we found that mortgage rates ended up peaking on April 8th. The global market found itself under considerable stress at the time from Greece and the Eurozone, and then finally things cracked. Safe haven buying picked up, and that pace hastened with the Icelandic volcano eruption. And then when May 6 came around, mortgage rates fell below 5%, which gave birth to the refi boom. At this point, the mortgage market was spinning out of control, and the homeowners, of course, were delighted about it. Rates dropped more based on the Eurozone volcano. North Korea was making waves, but it was between March and May when we looked back and saw that the U.S. housing sector had showed up strong and the economy had added close to 1 million new jobs. This was moving inflation talk to center stage, and that counterbalanced the forces that should have brought rates down to 4. That is, they counterbalanced up until the middle of August, and that's when the markets took a step back for inventory, and traders saw that the economy might not be so high-flying after all, which again was a good turn for mortgage rates. Home builder confidence was lagging, credit had yet to loosen up, and the jobs market had turned back to the red. Meanwhile, the refi boom continued, entered its 5th month, and we can see here versus the start that rates were lower by nearly an entire percentage point from earlier in the year. The Fed noticed this slowdown too, and suddenly said that deflation, not inflation, was its bigger concern. These comments reignited the refi boom, and the Fed didn't stop there. It then started talking about ways to prevent deflation from happening. This included a new bond purchase program, and if you remember, the Fed's first foray into bonds took mortgage rates down by a ton, so markets started making bets this would happen again. And by the time that the end of October, early November came around, mortgage bonds were dipping again, and mortgage rates fell right around the first week of November. They fell to an all-time average low of 4.17%, just ahead of the Fed's November meeting, and then suddenly they stopped. This time around, the Fed's plan to print $600 billion in new money was deemed inflationary, too inflationary really for the markets, and especially because housing and jobs appeared to have renormalized and global growth was resuming. So instead of buying mortgage-backed bonds, investors started selling them quickly, and rates start to uncoil. After 8 months now, the refi boom ends. Now, less than 2 months have passed since the Federal Reserve announced its second market intervention, and in that time, mortgage markets are much, much worse. Mortgage rates do fall some days, but those days are far outnumbered by the days on which rates rise. It's dizzying, really. On a day-to-day basis, mortgage rates are moving as much as 0.25%, and lenders are changing rate sheets up to 5 times daily. As a lot of people are finding out, it's very, very hard to shop into a market correction. Despite the rise in rates, though, it's important to recognize that 2010 ended sub 5%, and that's excellent. It's lower from where the year started, and versus history, it's amazingly low. It's one reason why we should expect rates to rise in 2011. Actually, historically, we should move closer to the mean. For more mortgage news and to stay current on today's mortgage rates, visit themortgagereports.com daily.